Good afternoon. I'd like to welcome everybody to our webinar, the Topics at 12 series. It's been sponsored by Susan Reagan, who is our Small Business Center Director with Rockingham Community College. We're very thankful to have the resources and all work together as a team. The Team Reidsville and the Reidsville Economic Development Team and the Rockingham County Economic Development Team and the Reidsville Chamber of Commerce in partnership with the Eden and Western Chambers of Commerce have brought you this webinar series. We are very excited to have Andrew Santulli with the SBTDC with us today as the speaker, who is going to be discussing cash flow management. So we are excited to be in, I think, the 5th or 6th week of this series, and next week will be about family-friendly policies in the workplace and how that can benefit your workplace if you are being flexible and creating an environment where you are being flexible for families. Especially, it's even more in this time of pandemic and uncertainty, it's even more very much a safe place for folks when you're creating those. So it's going to be a great webinar, and we're really excited about that. But without further ado, we're going to get started today. So Andrew, take it away, cash flow management.
Good afternoon. Very pleased to be with you today. We're going to talk about a topic that often impacts people and really not everyone has a clear understanding about what cash flow is all about. So this presentation we're giving you right now, we're going to be working from about 5,000 feet and give you kind of an overview of the whole area of cash flow. Everyone's situation, as in most cases, are a little bit different. So if you need to dive in deeper, which often is the case, you can be free to contact Susan Reagan in Rockingham County or myself. Okay, and we'd be happy to discuss this with you on a one-on-one basis and how it impacts your business personally. As part of this, what I'm going to go through is a personal cash flow, okay, basically a family statement, and then we'll look at a business one. And a cash flow statement is very much similar to a bank reconciliation. Some people don't do them anymore, but if you've done a bank reconciliation, you've done a cash flow statement. So without further ado, Roy, let's flip to the next. Just to give you a little background, my background is I've been in manufacturing and business for 35 plus years. Started my career back in the 60s with the aerospace industry when we were going to the moon. So I worked with Grumman Aircraft, worked in the electronics industry for some time, and then I spent most of my career in the furnishings industry, both domestically and internationally. It's in that area where I spent a great deal of time working with cash flow statements and with accounting. And after that, I then started my own business around 2000 and was involved in similar challenges as individuals who I assume are sitting in with us today. For the last 9.5 years, I've been a counselor with the Small Business and Technology Development Center out of the Triad area, and Rockingham County is one of the counties we serve. So if for some reason you need some support from the Small Business and Technology Development Center, I'm available. Your primary resource, though, up in Rockingham is Susan Reagan through the Small Business Center. So let's go to the next one. One of the big things we hope you're going to learn today is about cash flow is what you don't know about cash flow, okay? And often that's our biggest challenge in life. You don't know what you don't know. So today, hopefully that's going to give you an opportunity to try and understand through the terms and terminology we go through, some of the issues that you may have in your business and are not sure on how to address them. So one of the things we want to understand is, why is cash flow important to you? Many of us have heard the expression, cash is king. Okay, and that's the idea that having cash, okay, particularly in this case in your business, puts you in a more stable position. And what does that do? That gives you better buying power. Let's take an analogy which you may or may not have heard of before. You know, as blood is to your body and as fuel is to a flying aircraft, you know, without the blood, your body would cease to exist or operate, function properly. Without fuel, and the aircraft engine stops, then the aircraft doesn't fly anymore. Well, in a similar way, without cash, your business crashes and doesn't continue to operate. So cash is the blood and is the fuel of the engine of your business. So why is is understanding cash flow important to you personally? One of the first questions we look at is, most of us on a daily basis who are running a business, we check our checking account balance every day. How much cash is in my checking account? Do I have a positive or negative balance? That particularly enables you to answer the question, can I make payroll this week? You know, often I'll have clients I'm working with and they have to resort to a line of credit, or they have to resort to taking money out of their own account because if this month was lean and sales didn't come in, I can't cover my payroll this month. Or they may ask their employees to hang on to the check. I gave it to you on Monday, but don't cash it till Tuesday because I got a big check coming in. I was sitting at a client's location not 2 weeks ago, and that was the case. They were handing out checks one at a time and asking people to hang on to it. I don't know if anybody can relate to this. If you've been around long enough, you probably can. The next thing is, can I pay my bills? And can I pay myself? In a small business, we've all learned the owner doesn't get paid first, they get paid last. If there's not enough money in the business, they may have to put it in. So instead of being paid this month, you may have to pay money into it. Can I order materials this month? That's why you, in every one of those circumstances, you were thinking about your cash flow. The other thing it does is it helps you to identify and address problems, okay, hopefully before they occur. Do I have reoccurring expenses in my business that are really unnecessary for today? Maybe at the time I took on those expenses, they were necessary or there was more money, but today it may not be there. You know, can I afford to have my vehicle maintained this month and go in for my scheduled maintenance, or do I have to put it off for a month? Can I take that business trip that I planned on going on? It may cost me $1,000. Right now, I don't think the business can afford it. Typically, I spend so much money every month on advertising. Yes, it's very important to continue advertising. I don't disagree. But if there's not enough money in the account, do I have to think that maybe I should put it off for a month or two? The other thing is understanding trends, all right? Seasonality. Seasonality exists in income and in expenses. And the longer you've been in your business, the more you understand it. Rarely does a business have the same revenue every month. Okay, there are some, maybe the insurance business where you get paid annuities, it may be reasonably flat, but in most businesses, it's not flat. There are selling seasons and there are seasons that don't sell as well. So for example, if you're selling clothing, okay, and there's a fall season for clothing and people start buying that clothing maybe in August and September, you're going to have to buy that clothing in advance so that you can sell it to your customers. So that may mean in June and July, you have to spend a large amount of cash in order to bring that clothing into your business so you have it available to sell 2 months later. That means you need 60 days worth of cash in order to be able to keep the business operating, because the product you buy in June and July will not be paid for by your customer to perhaps September or October. So that's a cash flow situation. I need cash in order to get through that short-term period so that I can sell it. So even if you buy the clothing for 50 cents and you're going to get paid $1 in September, in June you need that 50 cents, and then you're going to have to afford to cover that until you get repaid with it in September. So that's a cash flow requirement. Probably the most important thing about cash flow is preparing for the future. What do I need in the future? What do I have to change in my business, or what do I have to adapt in my business? And almost everything you need requires cash. One quick example to look at is taxes. If you're paying payroll taxes, if you have employees, typically most of us end up, if our payroll is not extremely large, and I'm talking most of our businesses that are under $1 million, we probably pay our 941s, our NC5s, which are federal and state withholding taxes. Usually we'll pay them monthly or quarterly. We withhold that from every paycheck. That is what is known as a trust account. Okay, the government will trust you to hang on to your employees' money until it gets deposited. So you want to make sure that that cash is available when you have to make that payment. What we typically recommend for people who are doing this is that they have a separate account and they transfer that money into that separate account each time. Today's business has become a little bit simpler. In some cases, there are payroll services that perform this function for you. And I recommend whenever, if you've got more than 2 or 3 employees, that you go ahead and use one of these payroll services, because you pay them all the money up front, the amount that goes to the employee and the amount that has to be paid on the 941s, the 940s, the NC5s, etc. And that at least puts you in a position where you're not spending cash that's not yours. That's another issue with cash flow. Am I spending the government's money and making believe it's mine? The other area that many people get into trouble with is sales tax. You sell something for $1, okay, and there's 6% tax due on it. You only earned 94 cents. The other 6% belongs to the state of North Carolina. If you record the whole dollar as revenue and put that in your checking account, come the end of a month, you may have $100, $1,000, $2,000 more in that checking account than is really yours, because you're holding those trust dollars there. And as anyone who pays sales tax knows, that the 20th of the month, okay, of every month, you have to pay the sales tax that you set aside or that you collected in the prior month. Understanding cash flow and understanding where that money is important. So once again, that's something we suggest you put into a trust account. The other thing that is important to look at when you're looking at the future and looking at details, there are some bills that come due not monthly, but quarterly or annually. An example may be is you pay your insurance quarterly. You may pay your vehicle registration annually. So projecting cash over time helps you understand when they come and make sure you have the money for it. An example of this is, if you would think of, is when you pay your mortgage. When you pay your mortgage, there's an escrow account often. So you pay mortgage, interest, and taxes in one payment to your bank. So if your taxes are $1,200 a year, every month you put $100 aside, and when the tax bill comes, the bank pays it for you. That's an escrow account. That's very similar to what you may experience here in your business and why you have to plan things out. The cash would go out, okay, 1 month in the year, but that would cover payments for the whole year. Okay, we can go on right to the next one. Let's define some terms here, okay? This may help us understand more about it. What exactly is cash flow? So one way we can look at it is cash flow is a measure of the movement of money through a checking account. Checking account is known as a demand account. That is, as soon as you write a check or you issue a debit card for a payment, that money is withdrawn from that account. So that's what's known as a demand account. And we typically measure cash flow over a specific period of time. Usually, what was my cash flow this past week? What was it for the month? Okay, and why do we measure it? Once again, going back to what we spoke about earlier, it is to prepare for the future. Yeah. Another term that comes in here, which I didn't define, which I'll have to put in a future time here, is run rate. Okay, when speaking to my clients, I often ask them to consider their run rate. And what is the run rate? Your run rate is typically the fixed expenses that you incur in order to keep the doors open in your business. So even if you don't sell a thing, if you sell a product, okay, or you provide a service, without selling anything, you've got to pay your rent every month. You've got to pay your accountant for doing your books each year. You have to have insurance just to keep the doors open. You may require vehicles or you may require equipment just in order to run the business. Your run rate basically starts with what is your fixed expenses. And if you want to get paid for operating this business, you may say, okay, I have to earn $60,000 a year. So part of your run rate is that $5,000 a month that you would like to earn in order to keep the business going. So that gives you pretty much a level number or a base upon which you build. So I need at least X amount of dollars in order to keep the business going. So in this case, if you wanted to earn $5,000 a month yourself, by the time you look at rent and everything else, you're probably going to have to say is I need at least, $12,000 worth of cash flowing into my business every month or more, depending upon what your other expenses are in order to keep the doors open. So that gets into run rate. Once again, every business is different. Susan, myself, or some of the other individuals involved in this could probably help you define what that run rate is. Two other items that come up from finance and we're also going to talk about in cash flow is the income statement or profit and loss statement, which many of you have heard of and probably look at regularly. And the other thing is the balance sheet. So what is the income statement? The income statement or profit and loss statement is a record of your business's revenue, that's the income coming in, and the expenses, that's the cost of generating the revenue, and then what's left after that, which is net income if your revenue is higher than your expenses, or the net loss for that particular period of time. Now, another way to look at this is, let's think of an illustration. My income statement is for a month or a year. And the way I define it, it's really a video, okay? A video goes over a period of time. So an income statement is what revenue came in, or income, and what expenses did I incur over a period of time. So if I ask for a P&L, the P&L is going to be for the month ending June, or the year to date ending June, or the week ending January 15th, all right? The next item we look at is the balance sheet. And what is the balance sheet? The balance sheet is a list of your accounts, which are included and categorized as assets, liability, and equity. We'll show you one of these towards the end. And this is taken as of a specific point in time. So if I ask you for a balance sheet, the balance sheet's would be recorded as of June 30th, 2020, or as December 31st of 2019. So a balance sheet we can equate to a photograph. It's a picture in time, a very specific date. Doesn't go over a period of time, it's as of a date and time. Just a little bit of difference between the two statements. And now when we talk about cash flow, the reason it's important to understand your income statement or profit and loss and balance sheet is there are figures or numbers taken from each of those, and the information from each of those together helps prepare your cash flow statement. Let's go on. Okay, this is something we're gonna look at from 10,000 feet, just so that you have an opportunity to understand some of the terms used in here. Be more than happy to explain this in more detail. Not that you're not capable of understanding it, it just may be that I don't have the time to go into depth. But what we're going to look at here is what's the difference between direct and indirect cash flow. You don't have to have a thorough understanding of this to enable you to run your business and manage cash. But in the first case, direct cash flow is for businesses that run on a cash basis of accounting. And the cash basis of accounting is when you recognize revenue, that's income, and expenses when the money comes into your account. And that's typical for most businesses under $1 million. You may have heard these terms cash basis and accrual basis from your accountant. And they say, do you want your book set up on a cash or accrual basis? Unless you really understand what's going on, that's a difficult answer to give them. And many people would say, well, I'll leave that to your discretion. Just as a point of information, if you're running a business that generates less than $1 million of revenue a year, you probably should be on a cash basis. It's less complicated and it provides you with more direct information. If you're running a business that's over $1 million, any public company, okay, must run on an accrual basis. They're much larger. That also deals with indirect cash. The biggest difference on accrual is that revenue is recognized when you send the invoice. So when you send an invoice to someone, that would determine that you earn the money in that period. For example, if you were selling a vehicle to someone, okay, and you were a car dealership, and you sold the vehicle to somebody in the month of January, okay, and you billed them for the vehicle that month, you would record the value of the vehicle in that month. Now, you may have set up a payment plan, okay, and you receive the money over the next 12 months. If you're on accrual basis, okay, you would now have what's known as an accounts receivable, and you would collect the money over a period of months. As opposed to being on a cash basis, you would only record the income as the money came into you. So enough of that. We'll be more than happy to explain that in more detail on a one-on-one basis. But that's the difference between a cash basis and an accrual basis. I assume most of the individuals signed on today's revenue is probably under $1 million. If it's more than that, more power to you. That's great, but you probably want to be on a cash basis. Let's go on to the next one, Roy. Okay, so what we're going to look at here right now is a personal cash flow worksheet. This is almost identical to a bank reconciliation. As I said earlier on, if we were going back 20 years, many people probably did bank reconciliations regularly. If you worked in accounting, you probably did them. Most people today just go online and check their account balance and trust whatever the bank gave them. This is the logic in what's in a bank reconciliation, okay? This is just laid out a little differently. And the way I'm going to start this is the Smith family. So at the beginning, what we're looking at is we start with beginning cash. And in this case, the beginning cash is the bank balance. In this particular case, on July 1st, there was $500 in their bank account. So that's the $500 we've got recorded on the top line. Now, what we're looking at this month is the cash that came in. It's got nothing to do with selling or anything else, but when we get into a business, it's very similar. So there were two wage earners in the family, Jane and John. They each earned $2,500 that month. So they brought $5,000 into the family household or into the checking account that month. So they started with $500, they brought in $5,000. During that month, they had a number of expenses. And at the bottom where it says total cash out, those expenses added up to $4,850. And some of the expenses were credit card payments, loan payments, your rent or their mortgage, utilities, fuel for the vehicle, cell phones, food, groceries, etc. So those are household expenses. Those were $4,850. They brought in $5,000. So that means their cash flow was $150 positive. So they brought $150 more into the family than they spent. And now their ending cash is $650 because they had $500 to start with in the checking account. They brought in $5,000. They spent $4,850. So there was $150 additional cash. The $150 added to the $500 is $650. So now they start the month of August and they've got $650 in the account. Once again, we look at what they brought in. Now, when Jane, that particular month, brought in $1,800, John brought in $2,500. In that month, they knew that they were going to be a little short of cash because Jane didn't earn as much that particular month, so they took $700 out of their savings account. That was cash into their checking account. They didn't earn it, but they did transfer it in. Another thing is they received a gift that month for $200. So the amount of money that was brought into the family account that month was $5,200. That month, they spent a little bit more money than they did the prior month. So they spent $5,375. So they brought in $5,200, they spent $5,375. So their cash flow was negative in that particular period. They spent $175 more than they brought in. The same principles apply to a business. So once again, the checking account started with $650. They brought in $5,200. They spent $5,375, which was $175 more than they brought in. So now the $650 in their checking account goes down to $475. And that's exactly what this is, okay? And it flows month to month. If we look at the summary at the end of 6 months, they started with $500 in their checking account at the beginning of July. If we go down to the bottom, they had $1,400 in their checking account at the end of the month. And let's try and understand why. Let's look between Jane and John. They brought in together $28,500, $13,800 for Jane, $15,000 for John. But during that period of time, they transferred $1,400 out of their savings account. That was cash that came into their checking account, but that's not money they earned that month or that 6-month period. They had $500 worth of gifts, $75 they made from yard sales, etc. So basically, they brought in, okay, $30,000, $30,775 came in, but $1,400 of that was not earned. That came out of their savings account. Their expenses for the month, for that 6-month period, were $29,875. So what happened is that they spent, okay, $500 less than they earned, but they had to put $1,400 in from their savings account. So if I was to look at this, you would say, how are they doing? I'm saying they're overspending a bit. They're overspending by, in this particular case, $900, okay? Their expenses are $900 more than their income is. So now let's switch to the next one here. Roy? We're going to go to the business cash flow statement. So the exact same principles as we talked about in the family, and it's often easier to look at it in your personal accounts. And if you've never done cash flow before, I recommend try doing it on your household or in your family first before you do it with the business, okay? It's much more personal and helps you understand it. So let's look at the business cash flow. So in this particular business, the business starts out same way. This is the same format. There was $850 in their checking account balance when they got started. Okay, and that was in month 1. During that month, they sold $600 worth of product or services. All right, but the owner put in $2,500 from their own personal account. This may have came out of their household savings account. So that meant the amount of cash that was put into the business was $3,100. That doesn't mean their sales were $3,100. Their sales was $600. And the reason that the owner had to put in $2,500 is because we look at their expenses. Their expenses were a little over $3,000 that month, almost equal to the amount they put in. So what happens now is that their cash flow by the owner putting in $2,500 was almost equal. There was a plus $55, all right? So their bank account balance went from $850 to $905. So without that $2,500, the business wouldn't have stayed fluid. There wouldn't have been any blood in the body. The business wouldn't have operated. And then what we see here is the 905 from the end of the month of first month is the starting number for the second month. Now let's look at this business for the 3-month period. The 3-month period, we started with $850 in your checking account. During that period of time, the revenue that was brought in was $2,940. Okay, but during that period of time, the owner also had to borrow $10,000 and put in $2,500 of their own money. The expenses for the period were $12,828. That's what it took to run the business during that period of time. And then at the end of the period, we're seeing that there's positive cash in the account, $3,462. But what was the purpose of this cash flow statement? Let's now read into this a little bit and try and understand what this is telling me. All right? May take a pencil to do this, okay? But let's look at it. When I analyze this statement, what does it tell me? It tells me that the sales for the period were $2,940. Roughly $3,000 worth of sales is what was brought into this business. I look at the expenses. The expenses were $12,828. So I spent, okay, about, let's just round the number, I spent $13,000, okay, to operate the business. My revenue was $3,000, I spent $13,000. So that means this business lost $10,000 during this period of time. That's why the owner went out and borrowed and put a $10,000 loan in here just to keep the doors open. So what did this tell me? It's telling me, my conclusion is this business is not self-sustaining. If the owner didn't put $10,000 in, they wouldn't have had any money to pay their bills. What does this tell me? This is where you need some help with your financials. You need some help with understanding how the business is running and what you can do. This is a great reason to look for a business counselor to help you try and understand what's going on and help you work through some of the issues that exist here. Often, most businesses don't know about this until their checking account is empty and checks start bouncing. Because often we don't keep our financials up to date. We don't know at the end of the month, for example, and by June 1st, we don't know what happened on May 31st. Often I'll speak to someone and they'll say, well, my accountant's busy and I don't get numbers for 2 or 3 months. Well, the business keeps running. That's why it's important to do cash flow projections, cash flow forecasting, actual cash flow. You probably want to know this week in and week out. You may not be the accountant, you may not be doing the books, but it's your money. You should understand cash, and you should be able to do these simple statements. So you really need to see this weekly and monthly, and you need to do the projections. People like Susan and myself are available to help you to try and understand this. Your accountants may understand it. Okay, some accountants do, some don't. My experience, okay, I've worked as an accountant for a long time, but I worked in business. Generally, people who do tax returns, and I'm not, saying that all of them this way, but some of them are not used to working with financial projections and financial reporting. They can keep your books and do a great job with it, but financial reporting may not be their bailiwick. So you may need somebody who has a little bit more experience with this. The next thing we're going to look at, Roy, next schedule is, I brought up the comment P&L and income statement and balance sheet. We're just going to look at one quickly to look at what the terms are and what the captions are in this particular case. All right. So this is a P&L, okay, or income statement. And this, I'm going to assume, and I did assume, was on an accrual basis because this business is going to, at $24,000 a month is going to do, a larger volume. So once again, this is a video. This is over a period of time. So in 2016, that's for the full year. So that's the year ending, okay, December 31, 2016, the year ending December 31st, 2017. So that'd be from January 1st through December 31st. This particular company had two product lines that they sold, product A and product B. And in 2016, the total amount in that year, they sold $24,000 worth of product. Their cost of sales, that is the cost of the materials and the labor and the packing material. So this is a company that sells a product. Let's say they're selling lamps, or say so they have the cost of labor in order to make the lamps, the material in order to build the lamps, and then the packaging to ship them. So that cost them $13,680. So that meant that they were left with $10,320 to spend on their operating expenses. Once again, operating expenses in my world is a run rate. So this company's run rate in that year was $10,895. That's what it cost them to run for that year. And these were their expenses. So they had $10,320 left after their cost of goods, and their expenses were $10,895. So they lost, $575 in that year. So their profit and loss statement showed an operating loss of $575 in that year. If we went back to their cash flow statement, they would have found that the owner either had to borrow money or put their own money in here to make sure that they covered that $575, because their checking account would have gone negative had they not done that. So you wouldn't see that from here, but some of the numbers come from here. The revenue would come from here, the expenses would come from here. Those go in the cash flow statement. What you don't see here would be the loans or the money that the owner put in. That would come from the balance sheet. So this is an example going over 3 years, and as the business goes on, by the third year, 2018, they generated a net profit or income of $3,255. Namely, their revenue was higher and therefore the revenue was higher than the expenses, and therefore they generated positive cash in that year. Okay, Roy, let's go to the next one. Here's our balance sheet. And this is the other statement we spoke of. This is now my photograph, okay? This is as of a point in time. So this balance sheet would have been as of December 31st, 2017 or 2018 or 2019, that particular point in time. And this is just a simple overview of a balance sheet. These numbers are not related to anything else. But a balance sheet, the way it works is assets equal liability plus equity. Anybody who's taking an accounting 101 would have learned about a balance sheet. To get into the details, you would have needed more, and most of us haven't. Unfortunately, I lived with this for a while. But assets equals liability plus equity, and that's what this does. So what is an asset? We're just going to look at that for overview purposes. Cash is an asset. In this particular situation, cash on hand. That could be petty cash that you keep in a drawer. Checking account. I spelled checking wrong. Checking account, they had $5,000 in their checking account as of December 31st of that year. Their savings account had $3,000 in it as of that day. So the total cash added up to $8,250. They had receivables. So this is an accrual accounting basis, because in an accrual accounting, we have receivables. So their customers owed them $2,500 for product or services they delivered in a previous period but have not been paid for yet. They would have had some prepaid expenses. So once again, in an accrual basis, okay, if for example, my expenses for insurance, okay, the insurance bill comes in March, and as of December, I put away 3 months worth, okay, ahead of time to pay that for them. So those would have been prepaid expenses. And then this is where our assets are, our fixed assets. They may have had land, they owned a building, they had machinery and equipment. And then another item, which shows up on your profit and loss statement, but not on cash flow, is accumulated depreciation. The value of these assets, you don't depreciate land, but the building and the equipment, okay, we charge that over time. That's another point with accrual. Over time, we charge the business the cost of that. So $8,000 out of the 25 plus the 8 have been charged to this business as of December 31st. So your assets are left, they're worth $35,000. So all your assets together are worth $46,000. The $8,250, the $2,500, the $250, and the $35,000. Now on the other side of the balance sheet, okay, which has to balance, we have accounts payable. So we owe customers $2,000 or suppliers $2,500. That's accounts payable. This business has an outstanding loan of $30,000. They have a line of credit, which they've used, of $4,500. So their total liabilities, this is what they owe people as of today, is $37,000. The other side of the balance sheet with liabilities is equity, and this is the part of the owners. The owner has equity. They put $5,000 into the business, and then retained earnings is a measure of what net profit or loss the business has had to date. So this business has had up to $4,000 worth of net profit. So their equity is $9,000. $37,000 and $9,000 together is $46,000. So now our balance sheet balances. So once again, as I said, we're looking at an overview from about 5,000 feet. We're happy to come down and help you, okay, as counselors, look at your business specifically and help you understand what your position is with yours. Once again, Susan Reagan up in Rockingham is your first line of contact. She can help you with this. If there's additional need, I can make myself available because Rockingham is part of our charge as well. And we're here willing and able. There's no charge for this on a one-on-one basis, as long as your intention is to keep your business operating and pay taxes to the state. The state is willing to pay our salaries so we can help you so that you can grow your business and be efficient. Turn this back over to you, Diane. If there are any questions, we'll try and see if we can address them.
All right. right, so we have a question that is in the chat box, and I'm going to read that. So we have Meredith Bailey, who's the founder and CEO of Butler's Pantry, which is an e-commerce business currently specializing in cloth face masks. Their mission statement is to reinvigorate NC's textile economy by employing local textile artisans to sew functional, stylish cloth face coverings for adults and kids. Do you have any recommendations for finding and engaging a business analyst to help with preparing cash flow statements? Groups or job boards where we should be posting, for example?
Well, the first place I would start, okay, if you initially need some help, okay, Susan Reagan can probably give you some more detailed information, but if you want to hire someone to do that for you, I would start with your local accountant. Ask your accountant, the one who does your books for you, okay, if they're comfortable and if they can help you with cash flow forecasting. If they're comfortable with it, that may be a great source because they're already dealing with your books. Okay, if you're doing your books yourself, okay, if you're doing QuickBooks yourself, etc., and you're not comfortable with it, this may be the time to engage an accountant. There are a number of accounting firms, in Rockingham County that you could go ahead and speak to, and I'm sure Diane can give you some leads on that. But once again, as I say, if you want to get a better handle on what you're looking for and some of the details so that you can ask the question more directly, get in touch with Susan. Her name is, and her contact information is here. She may be able to give you some help. If there's some additional details needed, I'm certainly available to give you some assistance with that.
Okay. I don't have any more in the chat box, but I would open it up for anyone else. If they would like to ask questions, you can just unmute yourself, or I'm happy to take them in the chat box as well. And I don't believe that we had any from the other hosts, so.
Once again, Diane, I know you're putting this up and it's available for people to look at. The terms may have come a little bit rapidly in this particular case. The terminology that I used in here often is not in the normal colloquial for most people. Accountants often can explain this to you. Sometimes, they may not explain it in a way that you understand. Okay. I have a lot of respect for accountants and what they do. It's a profession I've been in myself personally for some time, but it's not uncommon often that accountants are not as involved in financial planning and analysis as they are in recording transactions. So that doesn't mean they're not good at what they do if they don't get into this area in depth. It's just another discipline. So that's why I suggest there may be some other sources to get this information from. Often you may want to talk to your financial planner. If you have a financial planner with whom you work, I have someone that I've worked with for 30 years, and he and I discuss this regularly. He understands this, as well as I do. And in fact, I help him with some of his other clients in this area, okay? Not everyone goes into a lot of depth doing cash flow forecasting, and then more importantly, interpreting what the cash flow forecasting is telling you. All right, to just record a financial statement, to just look at it, okay? It's like anything else. A doctor looks at your lab tests and they see something completely different than you or I would see. The same thing is true with a financial analyst. They look at your financial statements and they see something completely different than a doctor would see. All right, so each of us has something different. A mechanic, they look at your car and they listen to your engine, okay, and they understand something completely different than you and I do. So it's not uncommon that someone that you engage for another related service may not see the depth or may not understand that. That doesn't mean they're not good at what they do. It just may not be that that's not their area of expertise.
Well, I think that I know we don't have any more in the chat, and it doesn't look like anybody has unmuted themselves. So I think, Andrew, we would thank you for being our presenter today and sharing all that great information. As you said, it is a lot, but the slides will be available, and also the recording will be available soon on several different outlets, but particularly on Facebook. And depending on how you found out about this webinar, you can always reach back out to whoever your contact is. I'm sure it's one of the 4 or 5 of us that have been working on this, and we'll be happy to send you the link. And if that's all that you have, Andrew, that's all I have for today.
That's it. Thank you very much. I appreciate it.
Thank you, everybody. Great session. We look forward to having you in the future.